Good afternoon and good morning. I'm Todd Rosenbluth. I'm the head of ETF and mutual fund research at CFRA. I'm really excited that you're joining us for the latest CFRA webinar, Opportunities in Real Estate Investing, Understanding the Rewards and Risks for REITs in 2020. So let's get started with an introduction of who's here with us at CFRA. In New York, I'm Todd Rosenbluth. There's a picture of me on the screen. I'm joined by my Washington, D.C. based colleague, Chris Kuiper, who covers real estate investment trust as well as other securities for CFRA from a fundamental perspective. Thomas Youn, who's a managing director and a portfolio manager at Guggenheim, is joining us. Tom runs a real estate mutual fund that we at CFRA have written about. We're really excited to have him be part of the overall program. So let's walk you through the overall agenda. I'm going to just give you a brief reminder about CFRA. We know we have some folks that are joining us that are not existing clients. Welcome. We'll then talk about the case for real estate investment trust exposure and some of the challenges. Chris is going to walk us through CFRA's outlook on some of the key industries and sub-industries within the real estate investment trust market. And then Tom and I are going to have a conversation about Guggenheim's investment approach to REIT investing, and in particular, the mutual fund that we at CFRA are covered and written about quite extensively. So with that, let's get started, and I'll join you just about what's happening at CFRA on our next slide here. So if you're not familiar, we are a research provider covering stocks, ETFs, mutual funds, as well as sector and industry views. We have a wide array of stocks, 1,500 in particular, that we cover with buy, hold, sell recommendations. The research is covered by a team of 75 analysts that support both our fundamental and our forensic research, both looking for opportunities where the stocks can outperform, as well as finding companies that are either misunderstood from a regulatory perspective or where there's accounting challenges. And we're really excited to be talking to you specifically about the REIT market and our coverage, because the REIT sector has done very well this year, but there's some great opportunities, but also some challenges, as we'll get to. We are also excited to be an independent research provider. There's a lot of firms that are out there that you may be working with, both in-house and external resources. We pride ourselves on not managing money, making investment trades. We don't have an asset management arm. We bring asset managers in to help educate our clients, but we are not an asset manager specifically, and that gives us the independence to call it as we see it, both on the favorable and the unfavorable side of the equation. When we rate ETFs and mutual funds, and we rate those independently with one another, and for the most of the time here, we'll talk about mutual funds and their ownership of individual stocks, our approach is more forward-looking than Morningstar's, in our opinion, and I think if you take a deep dive into both the respective products, you'll notice a significant difference. We cover individual stocks, as we'll talk about, and then we use that stock research both from a valuation and risk standpoint, leveraging our deep team of analysts to offer an opinion as to what is inside a mutual fund. We also take into account things that are fund specific, so the expense ratio of the fund and other key costs, the track record of the manager. We're talking to a strong portfolio manager that's been with the fund for an extensive period of time. We believe that if Tom walked out the door, that would be a risk that investors would need to consider. We're glad he's not doing so and that he's here with us to be able to talk things about the real estate market. And so, Tom, let me bring you in as we move to the next slide here and hand off to talk about what's going on and the case for REIT investing. I'll let you walk through as we move to the next slide.
Great, thanks, Todd. So let's start off with making that case for REITs and why they deserve an allocation within a diversified portfolio. And of course, we'll touch on some of the key challenges with investing in REITs as well. So to start off, REITs provide the potential for very attractive total returns. And so on this slide, we're simply showing long-term total returns for the S&P 500, the Barclays Aggregate Bond Index, and of course, the equity REIT sector on the right. And these are trailing 20-year returns, and you can see that REITs have delivered very attractive returns compared to most major asset classes over a long period of time. And in fact, that's actually been pretty consistent across most time periods, going from 5 years back all the way back to 25 years. Now, I'm not suggesting that this level of outperformance will continue, but I think when considering REITs for an allocation within a portfolio or thinking about REITs within a broader portfolio context, I think it's important to bear in mind just how strong the total returns have been and that they have the ability to generate these levels of returns. On the next slide, we highlight our second point in that in addition to the potential for high total returns, REITs, of course, offer an attractive balance of income and capital appreciation. This slide is simply showing those same 20-year returns for the same asset classes broken out between price appreciation versus current income in the bluish color. And you'll see that if you look at the total returns for the S&P 500 over the past 20 years, about a third of those returns were generated from dividend yields. And in comparison for the REIT space, roughly half of the total returns are generated from current income. The third case, or the third point, as to why there's a strong case for REITs within a broader portfolio context, is that it also provides a potential hedge for inflation. So despite the relatively high yield, they offer inflation protection, unlike many other higher yielding fixed income alternatives, other fixed income alternatives with fixed coupons. Bear in mind that as inflation accelerates, that typically translates into higher market rents, which, if you continue to connect the dots, ultimately translates into higher dividends. So therein is your embedded inflation protection the REITs offer. Lastly, in addition to not only enhancing the potential for total returns as well as higher yields, REITs can also provide a reduction in portfolio risk and enhance diversification. If we go to slide 12, please. Slide 12 shows a chart of rolling 3-year correlations between the S&P 500 and the equity REIT index. And the takeaway here is that the correlation isn't consistent over time. And over a full cycle, it'll change. Sometimes it'll be quite correlated. Other times it'll be negatively correlated with the broad market. And so, again, adding this REIT exposure can not only enhance your returns, enhance your yields, but it can also reduce your overall portfolio risk as well. So moving on, these are all great benefits, but there are some challenges in investing in REITs as well. And they are namely the potential for higher volatility on a daily basis, as well as potential for large drawdowns. So again, comparing the same asset classes, here we're plotting or charting annualized returns, volatility in the middle, and the max drawdown over the past 20 years. And you can see that clearly REITs do exhibit more volatility on a daily basis, and they have suffered pretty significant drawdowns in the past. Now, I would remind you that these numbers are skewed quite a bit by the Great Financial Crisis. If you recall, real estate was, at the center for that downturn, and so REITs suffered disproportionately. I would argue that next time around, REITs are in a much healthier position today fundamentally than they were before. And I would ask you to bear in mind that traditionally REITs have actually been a defensive sector because of the contractual nature of their cash flows. So I hope that's a helpful overview of a lot of the benefits that REITs have to offer, as well as some of the challenges of REIT investing. Todd, I'll turn it back over to you.
Thanks, Tom. And before I bring in my colleague, Chris Kuiper, to walk through CFRA's view on the REIT outlook, I would encourage you to submit questions during the session, both based on what Tom has said, what Chris has said or will be saying, and other questions that you may have about real estate investing. Overall, we'll take as many questions as we can before the end of the session. So with that, Chris, thanks for joining us. I'll let you kick off on your next slide. Chris?
Apologies for that. Can you hear me now?
We can, Chris. Thanks.
Okay, great. Thank you. All right. So page 15, wanted to start out with REIT macro overview. Just looking at net operating income, NOI, which is a pretty standardized metric for REITs. You can see from 2010 up until now, we've had a pretty interesting inflection point where NOI has really taken off. This is growth in NOI of existing REITs, but also the addition of new REITs. And while the existing categories have certainly grown, like retail and residential, you see some new categories being added on top of those bars, specifically specialty, data center, and infrastructure. And so data center, to give you a brief overview, these are places where you store a lot of your data, especially with everything going to the cloud. If you use a corporate cloud or a personal cloud, that data has to sit somewhere. A lot of times this is data centers. There's some big ones being built out here in Washington, D.C. Infrastructure, what we're really talking about there are cell phone towers, so companies that operate and lease space on towers and buildings. Not only has that been a huge driver lately with the rise of mobile data consumption, but we also see a big inflection point with 5G coming over the next few years. 5G is expected to be a lot faster, but because it operates on a smaller wavelength, they're going to have to build more towers to increase their coverage area. So the point here is just to show that we think the REIT space is going to get bigger, and not only with existing REITs, but also it will continually add new types of REITs. Moving to page 16, looking at total return for REIT property types. The specifics here aren't really important. What we're really trying to hammer home is that just over 1 year, you have an incredible dispersion in the returns from different types of properties. You see that fan going out from the same point just 1 year ago. You've got industrial on the top returning over 40%. The very bottom there, you've got hotel REITs down over 10%. Retail as a whole is about flat. And so this really emphasizes to us that people think of real estate as a homogeneous group, or they might think of the sector as one big sector that moves together. But really there's a lot going on underneath, and it really presents an opportunity for why active management can be a very rewarding endeavor in the REIT space. Turning to page 17, again, just showing that within REITs, there's not only the different types, but you have a pretty good dispersion. There's not one dominating type. You can see the top 10 chart there on the right by market cap. You have pretty much every type of property represented there, with the exception of maybe office, which tends to be a little more fragmented, as well as the smaller REITs like lodging or diversified or specialty. Page 18, we're now going to dive into two specific REIT property types, just to give you an idea of how we look at them fundamentally and why there can be such a big difference in their return and what's going on. So the first one, as you saw in the previous slide, industrial, which is just on fire, the 5-year price performance there up over 100%, and compared to a little over 20-25% for the broad REIT index. If we turn to the next slide, we'll get into why have industrial REITs outperformed so well. I'll take a step back just to make sure we know what we're talking about when we say industrial. It's not really industrial in terms of manufacturing. You can have light manufacturing facilities in this property type, some R&D, but the bulk of what we're talking about is warehouse and logistics space. So these are the big football field size buildings that you see maybe from highways or next to rail yards or ports. They'll have a side of bays for trucks and trailers to back into, and they're going to be handling a lot of the storage of products as well as the logistics of shipping it in and out from different modes of transportation. So the big demand driver for these warehouse and logistics REITs is e-commerce. E-commerce is growing at 3 times the rate of total retail sales, so about 15% versus 5%. And remember, total retail sales includes e-commerce. So really, if you look at just brick and mortar retail, that's only growing at 2 to 3%, about GDP rates there. But that raises the question, well, why does e-commerce drive the demand for logistics and warehouse space? So if you think of a typical brick and mortar store, like a Best Buy or Bed Bath Beyond, you've got a big box retail store. You can hold a lot of inventory there. You can accept returns there. You can process and store returns. And you can take care of a lot of the storage off-site in your various retail stores. Now, as you move that to online retail, or if you have a retail-only or native online-only brand, you're going to have to move all of those functions into a warehouse space. So People shopping online expect more selection than when they go in the store, so you've got more SKUs. You hopefully have higher inventory turn out of one center rather than multiple centers in a city. And then you're going to have to move all of those returns into your warehouse center as well. For an apparel retailer, for example, that can be quite high. They can have as much as 20 to 30% of their sales returned. That's the demand side. And then a quick note on the supply side. So why isn't supply keeping up? It actually used to be that supply could keep up a lot better. They would build these warehouses outside of the city centers on land that was cheap. They were quick to slap together relatively inexpensively. But again, e-commerce, here's the story where they're changing this business model. With e-commerce, customers expect at least 2-day delivery, now going to 1-day delivery or even same-day delivery. So to achieve those lead times, retailers have to move their product closer to the consumer. The consumer is increasingly in dense metropolitan urban city centers. So they're going to have to find space within these city centers to ship out of. That space is increasingly scarce. It's also very hard to obtain zoning, entitlement, traffic permits for these spaces as well. And the retailers are happy to pay up for this. Logistics space is usually a small percentage of their total cost. So these industrial REITs are able to pass on price increases of 10, 20, even as high as 30% that we've seen. Shifting gears now to a property type that has not been doing well on page 20 here, retail. As you can see, all of retail is vastly underperforming the index over the last 5 years. And within retail, we split it out between shopping centers and malls. Malls is that orange line that's the furthest down 30%. That's really been dragging the index down as well. Turning to the next slide, 21, just like REITs in general, you can actually subdivide retail REITs into different types. So here's just the 3 main types and some of our fundamental outlook here. Enclosed shopping malls, we previously believed that a lot of the negative news you saw on TV of shuttered malls and vacant malls was really contained to the lower class B and C is what they call them. And those really weren't owned by publicly traded REITs. They were owned by individual investors, mom and pops, private LLCs. However, as we saw the pace of store closures accelerating, we believe this wasn't just an Amazon effect, but really a change in how people were shopping and wanted to shop. And so we changed our opinion about a year ago and said, even the higher class malls are going to face this difficulty as well. So really, they're doing stuff to try to curtail this, which we can talk about later, but it's just not enough and not fast enough. And so really our focus now is on the balance sheets of these malls that have taken on an increasing amount of debt. They have lower cash flow from the bankruptcies, and they're going to need more cash to reinvent their stores. Shopping centers, a lot of the tenant fallout already happened a couple of years ago. They'll probably muddle along, but those with grocery store anchors or necessity shopping will probably do a lot better. And then the last type is freestanding. This is really the most resilient type within retail. This is your single store, single building. So think of a freestanding CVS or a Walgreens or a movie theater or a gas station. They tend to be service oriented, so less susceptible to the rise of e-commerce. And then they often have triple net leases, which means the tenant pays pretty much all of the operating expenses like real estate taxes, insurance, maintenance. So they're really protected against some of those inflationary pressures there. The only thing we would caution here that we're seeing is valuations are starting to be elevated as more and more investors look to this type of property as they reach for yield in our low interest rate environment. So that's just some of the things we look at. We can talk about more later, but at this point, I'll turn it back over to Todd.
Thanks, Chris. I think that was a great overview of what's been happening within the REIT space from an investment perspective and digging in about the fundamental research that we have here at CFRA and how we use that, again, to discuss and cover individual mutual funds from a forward-looking perspective. So with that, I want to bring Tom back into the conversation. And Tom, we'll move to the next slide here. But Guggenheim has a unique investment approach with a focus on trying to reduce the volatility. I think this slide speaks to that well. Maybe you can just add some color about the overall objective and design.
Yeah, sure, Todd, thanks. So, at a high level at Guggenheim, we've taken a very different approach to REIT investing. And it's an approach that's enabled our strategy to consistently outperform the benchmark while generating one of the highest risk-adjusted returns versus our peer group. And in short, the strategy is designed to provide all the benefits that I mentioned earlier that REITs offer, while also managing those challenges, the risk and the volatility that REITs can sometimes suffer from. So let me just start off by highlighting these 3 points of, what makes the strategy so unique. Well, first of all, the objective of the strategy is two-pronged. Of course, we want to outperform the benchmark and deliver all of those benefits that REITs offer, but we also want to manage those challenges and the volatility and downside risk. So we have explicit risk reduction targets. We want to minimize and reduce daily volatility by at least 10%, and we want to cut any major drawdowns, something in the order of double digits, 10% or more in terms of the benchmark. We want to reduce those drawdowns by 20% or more. So how do we outperform the benchmark while cutting so much risk? We had to develop a very unique approach and framework to do so, and that framework entails combining a traditional long-only strategy with a market-neutral long-short REIT strategy. Those two strategies operate independently within the fund, and then on top of that, we layer the third component, which is a risk allocation framework, which effectively modulates the beta of the fund to the REIT index, depending on what the current market conditions look like. And so by modulating the allocation between those two sleeves, we effectively modulate the beta of the fund. I would think about this approach as kind of like a three-legged stool between the long-only sleeve, the long-short sleeve, and the risk allocation model. And the interaction of those three components provide three potential sources of excess returns, and it's the way in which we actively reduce risk of the fund. The last point I would make is that this framework has delivered on this two-pronged objective, and it's delivered very consistently with repeatable results. Inception to date, the fund has indeed cut daily volatility by about 16%, and we've cut major drawdowns every year that we've run the strategy anywhere from 14 to 34%. And of course, we didn't sacrifice performance in doing so. Inception to date, net of fees, we've outperformed the benchmark by roughly 200 basis points. So that's a quick overview of what really differentiates the strategy.
So Tom, we'll move to the next slide here, and you touched on briefly the long-only strategy and the market-neutral approach to it, but maybe we can dig a little bit deeper in terms of both the top-down and the bottom-up perspective to build the portfolio.
Sure. So diving in, let's take a look at the underlying sleeves and start off with the long-only and market-neutral long-short sleeve. Again, both are run independently within the fund. Bear in mind that the long-only strategy always targets a 1 beta or full market exposure at all times. Its goal is to outperform the benchmark. Whereas the market-neutral strategy, as the name implies, targets 0 beta to the REIT index at all times. It never takes a directional bet on the market or the REIT space in general. And it's fundamentally a long-short pair trading strategy where we're simply trying to exploit relative value opportunities within the space. Now, both of those strategies utilize the same relative value framework to try to determine, what is overvalued or undervalued within the REIT space. And this is a specialized framework tailored specifically for REITs, and it served us very well over a long period of time. We look at REITs more like a private real estate investor than a general stock analyst or whatnot. And so as an example that, our primary valuation metric that we focus on is net asset value, which is the current mark-to-market liquidation value of any REIT portfolio if you were to liquidate that portfolio in the private marketplace today. So that's very different than the way a lot of financial analysts or other journalists would look at the space, where you would focus on earnings yields, dividend yields, or perhaps earnings multiples. So it's a different lens, it's a different framework. And I would mention again that this framework has delivered very consistent alpha. We've been running the underlying strategies, this long-only strategy, as well as the market short strategy for almost 10 years now at Guggenheim. And we've outperformed each respective benchmark with every year except for one by a nominal amount. So again, when we're using this framework, we compare public versus private real estate markets and conditions. We generally develop top-down views as to which property types we want to focus on, and we're more constructive on or more pessimistic on. And we form views on geographies, whether it might be East Coast office versus West Coast office. And that largely drives our sector allocation and weighting decisions. Stock selection, on the other hand, is typically done on a bottoms-up basis, where we do our fundamental due diligence on individual names. And, if we look at our inception date attribution, that's where most of our alpha is generated. Roughly speaking, about 2/3 of our alpha has been generated from security selection, with a balanced sector allocation. Down below in this slide, we provide a brief overview of strategy guidelines for both the long-only and long-short strategies. But again, I think the key point there is that the long-only strategy is always targeting full exposure to the market, 1 beta, while the market-neutral strategy is always seeking to have as little exposure to the market as possible, or 0 beta.
So, Tom, I think the audience would be helpful for them to see, and this next slide walks through it, about how you think about allocating between these different exposures. What is driving that?
Sure. This is probably the most asked question that we receive on the strategy is, how do you determine what your market exposure should be? How do you determine what the allocation should be between those 2 sleeves? So as I mentioned before, we've developed a risk allocation framework. And so that starts off with a risk allocation model that effectively tries to measure current market conditions for REITs. And so we look at a number of different fundamental factors. We've grouped them up above here next to number 1 under 5 different general buckets, whether it be valuation measures, commercial real estate lending conditions, macroeconomic indicators, and even REIT technicals. And we're basically we believe that these various factors drive forward returns for both commercial real estate and for REITs. So we look at each of the individual factors, and let's take a valuation indicator, for instance, and we'll measure current levels and take a look at that historically to say, at this level today, what has that historically translated to in terms of forward returns for REITs? Was it generally positive or was it negative? How positive or negative was it? And what was the batting average of that? And so at the end of the day, we end up scoring each of these metrics based on current levels on a 1 to 5 scale, 1 being bearish, 5 being bullish. And the second step is to aggregate those scores and create one composite score, which is the ultimate model output, again on a 1 to 5 scale. The last step is to convert that score into our targeted allocations. And so you'll notice that this is somewhat mechanical, that's not as subjective. And down below under number 3, you'll see an area chart that shows, based on the model score, what the corresponding allocation targets will be. So a few things to note here. Under most conditions, ordinary conditions, the model will be somewhere in neutral, in the neutral range, somewhere around a 3. And that would translate into a long-only allocation of about 90% and a long-short allocation of about 40%. So under most conditions, we're going to run the fund with about a 0.9 beta to the index. And that's how you get the 10% daily vol reduction. Now, just to kind of bookend how much the exposures can modulate, if we run through our back test, the lowest exposure, the most defensive the strategy would have gotten would have been during the financial crisis, where the long-only allocation would have been 44%, the long-short allocation would have been 86%. On the other side of the spectrum, coming into a recovery, the most aggressive the fund would have called for 110% long-only allocation with a 20% long-short allocation on top. The other thing I would note is that the strategy isn't really, this framework isn't really designed to catch month-to-month moves in the index. It's really longer term. It's designed to catch cyclical tops and bottoms. And so we're really looking for an indication that all the fundamentals are really stacked against you, or they're generally in favor of a positive forward REIT returns. And again, as I mentioned before, this is more objective in nature. We remeasure and rerun this model on a monthly basis, and we adjust our allocations accordingly. There's not a lot of subjectivity that runs into this by design. So that's a quick overview of how we allocate between the two sleeves and determine our overall market exposure.
Thanks, Tom. So we're on this slide here, and then we'll do briefly on the next two slides in terms of performance. But I found this interesting in terms of, while we've had up years in many cases for the real estate market, when there, on a calendar year basis, there's been significant drawdown within the index, and the fund has performed even better. It's fallen less sharply. Maybe you can just talk through a couple of those periods.
Sure. You know, as you mentioned, look, every single year that we've managed a strategy, perhaps except for this year, there's been a major drawdown, somewhere near double digits or more. And even though we've been in a rising market, the fund has consistently cut those drawdowns meaningfully. And you know, I think this is a very important slide, because I think if you just simply looked at our fund's performance versus our peers or versus the benchmark, you know, we stack up well, but this will get lost if you're not looking at this. Just how consistent we've been able to cut major drawdowns and protect investors' capital. So, I mean, generally speaking, you know, we are typically running with less than 1 beta of the index, so that's helping. But in addition to that, you know, across most of these periods, I'd have to double check, but I'm arguing probably every single one of these periods, while the market is drawing down, you know, our long-short strategy is typically generating positive returns. And so not only are you benefiting from having less beta to the index in those drawdowns, but you're also generating positive returns with a portion of your capital on an absolute basis. And so you combine all that, and that's how you end up with such strong and consistent drawdown reductions.
So on the next slide here, I think this is also visually appealing in showing, relative to the benchmark, which sleeves of the portfolio, and from an asset allocation perspective, what is and is not adding value, gross, and then of course net of fees.
Yeah, so this, you know, as I mentioned earlier, I would think about the strategy and this unique framework as somewhat of a three-legged stool, where you have three components that work together to generate excess returns while also reducing risk. And so this is basically our inception to date performance attribution, where our performance is decomposed down to those three components: the long-only sleeve, the market-neutral long-short sleeve, and the risk allocation framework. And so on the very left, you can see that since inception, it's had a very strong market, and REITs delivered annualized returns of just 10%. If you look at the alpha generated by our long sleeve on its own and our allocation to long sleeve, that alpha contributed another 170 basis points of excess returns. Moving to the long short sleeve, again, this is the absolute return strategy, zero market exposure, but based on our allocation, the absolute returns generated there, that added another 200 basis points of excess returns to the fund overall. Now, the third component, which is the risk allocation model, has been a drag on performance. And as I mentioned before, we typically run with less beta than the market. So given that, you know, the fund's been, you know, running now for, call it roughly 5.5 years with an average return of 5 to 10% a year, you know, that's been a drag on performance because we've been running with less than full market exposure. But again, as I mentioned before, this is a longer term model that's designed to catch cyclical tops and bottoms. And I would argue that if we were to have a recession in the next 12, 24 months, or whenever it would come, and we had a major market sell-off, I would hope that that number would actually turn positive, and that our allocation model would help us stay defensive heading into that downturn, and help us actually generate a positive contribution to the fund. Lastly, deduct about 100 basis points of fees and expenses, and you end up with a, you know, just north of a 12% annualized return for the strategy. Again, outperforming the index by about 200 basis points, and as I mentioned just before, with significantly less risk than the benchmark overall, and of course most of our peers.
And so wrapping up here, thanks Tom, on this next slide here, you showed about since inception, and I'll just as much leave this on the screen, and maybe you have a brief comment about, you know, the various share, less the various share classes, and then just the various time periods of how the fund has performed since inception, as well as during, you know, 1, 3, and 5 year periods. I don't know if there's anything you want to add to this other than I think the numbers speak for itself.
Yeah, I mean, again, when I look at this chart, my key takeaway is that the performance that the fund generates is very consistent. Up markets, down markets, flattish markets. I think the fund has outperformed every single year that we've run the strategy. If you look at this year, for instance, I mean, REITs have had a very strong return, along with all risk assets, where REITs are up anywhere from 25 to 30%, depending on what your measurement period year to date. And we're actually running at about a 0.8 beta to the market. We're actually slightly more defensive than neutral. And even though we're running at a 0.8 beta and our benchmark is up, 25+%, we're still outperforming the benchmark year to date. And so imagine if we actually had a downturn again. I would argue that we have the potential to generate significantly more outperformance in that scenario. But again, this is by design. This three-pronged framework, if you will, this risk-managed framework, has been able to generate very consistent returns year in and year out. Again, look at it over 3 years, 5 years since inception, or even year to date.
Thanks, Tom. I appreciate all the color about the overall fund. On the next slide here, this is to serve two purposes. One, we at CFRA wrote recently about the Guggenheim strategy, the ticker GURIX. We decided to do a profile in advance of this conversation for folks that they didn't have to take notes. You can find that on our MarketScope Advisor platform. If you want to receive it and you don't have access to that part, the mutual fund part of MarketScope Advisor, or your platform doesn't have access to the mutual fund part from CFRA Research, please let us know. You can use the question box and just say, send me the report. We'll know exactly what you meant. Separately, we at CFRA do a weekly newsletter. Our marketing team pulls this together. It's really great content. Some of the best content that our analytical team has published throughout the prior week, talking about stocks, mutual funds, ETFs, industries, and sectors. So if you're not receiving that and you'd like to do so, you can submit another question, basically saying, telling us that you'd like to receive that directly from us. Now, I'll put this up for the Q&A questions that were actual questions, and we've had many of them that have come in. Unfortunately, we may or may not get to all of them, but please keep sending them in, and we'll certainly follow up. Chris, I want to bring you back into the conversation, and in part because Prologis is a key holding within the Guggenheim product, and you cover that stock and I believe are favorable on that stock. Maybe you could just talk through why you have a favorable recommendation on Prologis.
Sure, thanks, Todd. So as you said, Prologis, we've had a buy and then strong buy rating or opinion on it for some time now. And the story is pretty simple from what you heard on the secular growth side with the rise of e-commerce. We like a lot of the industrial REITs, actually. We particularly like Prologis because it is by far the largest one, as you saw in that chart, and they recently announced they're intending to acquire Liberty Property Trust, the number 3. So they continue to roll up competitors and get bigger. It is a game where there's economies of scale. And they're also one of the only ones that has a lot of international diversification.
That's great. Tom, I'll take the next question for you and more let you choose. We got asked specifically about some of the stocks that are within the portfolio. Rather than my naming them, I'll let you choose one of your long ideas and why you think it should be more on investors' radar.
Sure. One long position that we're very excited about is a company called Safehold REIT, ticker SAFE. It is a relatively new REIT that's underfollowed by the street and is generally mispriced and misunderstood from my viewpoint. And so this is a company that's exclusively focused on investing in ground leases on high quality institutional commercial real estate. So think of the land under a New York skyscraper. They own the land, not the building, and they're leasing the land to the building owner. They structure those ground leases as 100-year ground leases that start off with a yield of about 3.5%, and they have contractual escalations in those rents of about 2% a year at minimum, basically adjusted for CPI if CPI is higher. And so the bottom line is with Safehold, you basically own a diversified portfolio of land that's effectively producing a 5.5% yield to maturity. It's super senior in the capital stack, effectively secured by the building improvements on top, and I'll go into that in a second. And if you look at comparable fixed income alternatives with similar credit profiles or maturity levels, those start with yields in the 3-handle range. So I think there's an enormous mispricing and misunderstanding here. So let's unpack that a bit. If you look at the way ground leases work, at the end of the lease, the building improvements go to the landlord, not to the existing building owner. If you're in the middle of the lease and your ground lessee defaults on their lease, the building improvements go to the ground lessor. So you're protected and you're in a very secured position, similar to the very senior tranche of any asset-backed security or CMBS or whatnot. So today, those sorts of credits, something with that sort of security and credit profile, would trade with a 3-handle in front of it. And again, if you look at the effective yield to maturity on these ground leases, you're looking at 5.5%, potentially higher if inflation is higher, due to that inflation protection. And so that's, again, an enormous spread and an enormous misvaluation. More importantly, I think there's a catalyst for the company in that the company has a game plan to monetize that difference. If you think about it, and they securitize a diversified portfolio of these high-quality, well-secured ground leases at anywhere close to 5.5% yield, I think that'll stack up very attractively in the fixed income market. So there are different plans in place to try to monetize that variance. And generally speaking, shares are trading at about $40 today. And I think you can conservatively come up with a fair value closer to $60 if you simply mark to market that cash flow stream.
Thanks, Tom. So I'll just reiterate or cover the tickers. So Prologis, the ticker is PLD. The stock that Tom was talking about trades under the ticker SAFE, S-A-F-E. With that, in the interest of time, I want to thank everybody for participating, but also to remind you about the next webinar that we have, which is just next week. Sam Stovall, who's our Chief Investment Strategist, and Ken Leon, who heads up the Fundamental Equity Research team here at CFRA, are going to have a discussion about CFRA's investment outlook. There'll be a number of predictions and what's ahead for investors in 2020. So you can see how to register on the slide, and we'll also follow up with you in particular as a thank you for attending this webinar. I will also thank you and thank Tom and Chris for joining us here at CFRA. We really hope you enjoyed the content. Please let us know what you think of it. There will be a survey that'll pop up. And in the interest of full disclosure, we will go through some disclosures here to make sure that we've covered our ground on this. Tom, Chris, thanks a lot. We really appreciate everybody participating. Have a great day, a great rest of December, and happy investing. Sorry, I didn't realize how many disclosures there were.